Hello and welcome back to the fixed income securities series of NISM. So let's start with chapter 1.6, that is role of monetary policy in debt markets. The effect of monetary policy can be best understood using the policy transmission chart. So this is chart 1.4. So we have the official interest rates and there is some expectation, then there is money market interest rates, then it is divided into different segments like money credit, asset prices, bank rates, and exchange rate. Then after that we have price developments. So this is the chart of policy transmission. So let's read more in detail about this. Bond yields are significantly affected by the central bank's monetary policy. Monetary policy at its core is about determining interest rates. Any change in policy rate affects the banks immediately as they have to borrow from and lend funds to RBI at the policy rates on a daily basis through repo and reverse repo rates. The new rates are passed on to the customers using a spread mechanism. The process is commonly known as monetary policy transmission. In turn, sovereign interest rates define the risk-free rate of return. The risk-free rate of return has a large impact on the price of thereby the demand for all types of financial securities, including bonds. Central banks can influence the direction of asset prices through monetary policy. The central bank may use various monetary policy instruments, both direct and indirect ones, to engineer directional swings in the economy. If the central bank thinks that the changed direction may be beneficial for the society at large, during recessionary period, the central bank tends to lower interest rates to pump prime the economy by inducing higher demand, which ultimately may lead to increase in asset prices. By lowering interest rates, the central bank ensures lower cost of borrowing to the corporate sector to foster growth. When the asset prices reach bubble stage, central banks may raise interest rates to downsize the effective demand to moderate the asset prices. Economic boom and bust cycles are well managed by monetary policy effectiveness. The Reserve Bank of India or RBI is vested with the responsibility of conducting monetary policy in India. The responsibility is explicitly mandated under the Reserve Bank of India Act 1934. The Monetary Policy Committee (MPC) constituted by the central government under Section 45 ZB determines the policy interest rate required to achieve the inflation target. The MPC has 6 members and is chaired by the Governor of RBI. RBI's Monetary Policy Department (MPD) assists the MPC in formulating the monetary policy. RBI has also set up internal financial market committee to monitor the liquidity situation in the financial system, specifically in the banking system. The FMC of the RBI meets regularly to overview the liquidity conditions in the market so as to ensure that the operating target of monetary policy is kept close to the policy repo rate. Monetary policy target rate is the interbank call rate because the stable call market rate ensures availability of adequate liquidity to banks at a reasonable rate, reflective of the market condition for most secured borrowers like banks. Any substantial change in the call market rate, either very high rate or very low rate, compared to the RBI policy repo rate for a longer period, brings the monetary policy into focus. The primary objective of monetary policy is to maintain price stability while maintaining required level of growth to support employment and income of the population at large. In May 2016, the Reserve Bank of India Act 1934 was amended to provide a statutory basis for the implementation of the flexible inflation targeting framework. The central government has notified in the official gazette that 4% consumer price index or CPI inflation as the target for the period from 5th August 2016 to 31st March 2021 with the upper tolerance limit of 6% and the lower tolerance limit of 2%. This would be the target for the RBI to foster its policy framework. The central government notified the following as factors that constitute failure to achieve the inflation target. The average inflation is more than the upper tolerance level of the inflation target for any 3 consecutive quarters, or the average India inflation is less than the lower tolerance level for the any 3 consecutive quarters. Prior to the amendment in the RPA Act in May 2016, the flexible inflation targeting framework was governed by an agreement on monetary policy framework between the government and RBI. The RBI Act has an explicit provision for the RBI to operate the monetary policy framework of the country to sustain growth and maintain price stability. The policy framework generally aims at fixing policy repo rate based on the current and evolving macroeconomic situation in the country as well as global position, liquidity condition in the economy, asset price levels, foreign exchange positions, etc. The RBI also fixes reverse repo rate as well as a marginal standing facility, that is MSF rates, linking the said rates to an interest rate corridor. Repo rate changes and repo rate changes are transmitted through supply of funds or absorption of funds through commercial banks and RBI linkage window called liquidity adjustment facility. So that's it for now. We will cover the next topic in the next video. Thank you.